Hello, I'm Stephen from TEFAT, and tonight I'd like to give a presentation on the balance sheet. I'll just check the alignment. The balance sheet, also called the statement of financial position if it's official reporting, is just a summary of it. It's listing your assets, your liabilities of the business, and the difference between total assets and total liabilities gives you owner's equity. And it's like a snapshot of the business, and its owner's equity is capital, so it's how much capital is in the business. So before the balance sheet is written up in manual bookkeeping, the trial balance has to be completed, all the general journal entries and the general ledger entries, and the closing figures for the period posted to the balance sheet just as they are for the profit and loss statement. So this is after the final trial balance. So with the P&L and my other presentation, you've got to transfer the trading account to profit and loss account and transfer profit and loss to capital later. But tonight I'm focused on the balance sheet. So as I mentioned, the aim of a balance sheet is to list all the assets of a company, then all the liabilities. Both assets and liabilities are categorized in two categories: current, realized in a year, like current assets or current liabilities, and non-current items, non-current assets and non-current liabilities, which are items which stay on the balance sheet for more than 12 months. So that 12-month time frame, if it's less, it's a current item. If it's more, it's a non-current item. And in the balance sheet, I'm going to give an example of a balance sheet later, but I'll just state that a subtotal must be found for all the items in current assets, total non-current assets, total liabilities, and total non-current liabilities. Then once those figures are in place, we add up the total current assets and non-current assets, which gives total assets. Also, we add up the figure for total current liabilities and non-current liabilities to get total liabilities. Now we find the difference between total assets and total liabilities, which is called net assets or owner's equity or capital, also called proprietorship, and that denotes ownership, that capital in the business, either the sole trader, the partners, or the company. So owner's equity denotes proprietorship, a proprietor, and capital is a credit item in the balance sheet, liabilities are also a credit item, and assets are a debit item in the balance sheet. So in the accounting equation, assets equals liabilities plus owner's equity. We could put all the figures, the debits and the credits, into that formula, and they should balance. Equity is something you have at your disposal. You own something like share equity, and that capital by the business can be used for investment or refinancing of future operations. The owner of the business, if we're looking at a sole trader, has choices, opportunity cost of what to do with his or her resources. However, if the net asset figure is low or even negative, the owner may need to seek funds externally to invest in new assets and or cover operating costs in the P&L. So in the balance sheet, assets are a debit and liabilities are a credit. That is consistent with the notion of the matching principle, where debits are offset by credits, the matching principle, and in our case, the assets are matched to liabilities. You need assets are matched to liabilities. You need liabilities loans to invest in assets. Assets are favourable, liabilities are unfavourable, but all businesses go through the process of lending and getting loans, both in the short term and in the long term. So you need loans to invest and maintain assets. So, yeah, I just said liabilities are unfavourable unless you enjoy having a coffee meeting with your lender, which might be a pleasant moment, nevertheless. The difference between the terms current and non-current is that current items, such as current assets and current liabilities, are realised or settled within a 12-month period, which we mentioned. Examples of current assets are bank inventory, accounts receivable. Examples of current liability are salary payable, accounts payable. These are short-term loans that the company must settle in a 12-month period for current liabilities. And that word payable, if you're having trouble flagging the accounts, is indicative of a current asset. That word payable, accounts payable, salary payable. But non-current items stay in place for longer than 12 months. Non-current assets are used for many periods. A building might last for 80 or 100 years. Some non-current assets may be subject to depreciation, which reduces the value of the asset to a new written down value after depreciation expense. Not all assets are subject to depreciation. Land is a good example. Land might go up in value, but it's still a non-current asset. But non-current assets such as cars and machines don't last forever. Eventually these are scrapped and must be replaced because these assets have an estimated lifespan. Even buildings are depreciated with a lifespan of approximately 80 to 100 years, maybe less. Examples of non-current assets are cars, machinery, plant and equipment, buildings, land, and the difference between intangible assets and tangible assets. Intangible isn't physical property, such as goodwill and patents. It's intangible, but tangible is a physical item, okay, in the physical world. So that's the difference between intangible and tangible. Intangible is not seen, and tangible is a physical item. So an example of an intangible item in non-current assets is goodwill. Goodwill is where the purchaser of a new business pays more for the business than the net asset value, which is the intrinsic value of the business, because the firm might have a good customer base turnover, so they're willing to pay more. So the difference between their purchase price and net asset figure is the difference of goodwill, and I gave an example in the P&L presentation. While a patent is another intangible asset which is maybe only represented by a patent document, but is actually a technology used in a production process, so that concept isn't seen so much in the real world. So that definition of tangible assets again, we can see all those items. In the balance sheet, assets are subject to depreciation are written in the balance sheet in the non-current asset range with original purchase price at the top, if it's a statement of financial position, not just a balance sheet for internal records. Below that figure, that purchase price figure, you put accumulated depreciation, which is the summation of all your depreciation expenses over time for that asset. And then you find the difference between purchase price and accumulated depreciation. It gives you a figure for written down value. And that accumulated depreciation figure is written in brackets because it's a negative figure. Accumulated depreciation is always negative. It makes the price of the asset go south. And then below that are those two items, purchase price minus accumulated depreciation. We put in the current written down value figure of the asset. How much the machine is worth today, written down value, after some of its value has been written off with some years of depreciation in its life of the asset. So no one is going to pay $40,000 for a standard family car that's 12 years old, aren't they? The value of a 12-year-old car has been reduced in value. You'd probably buy that sort of a car between about $3,500 and $6,000, depending on the condition of the car. I'm only going to just touch on depreciation procedures in the depreciation schedule. I intend to do another presentation on that. Depreciation in Australia, the ATO rules is that you can choose either straight line or reducing value methods. Now, if you choose one method with one asset over its lifespan, you can't change. But if you get a new asset, like a new car later, you can elect reducing value. So you could have some assets being depreciated by straight line method, or some assets being depreciated by reducing value. Straight line depreciation is when a set amount is taken off the value of the asset each year, say $1,500 per year to get a new written down value figure each year. But the reducing value method is when the accountant depreciates the value of the asset each year with a set percentage figure, which doesn't change, for example, 20%. This means that the depreciation expense amount will change each year with the reducing value method, also called diminishing, unlike the straight line depreciation where the same amount of depreciation expense comes off every year. So with the reducing method figure, you get very high depreciation expense figures in the early part of the asset, the first few years, but at the end of the life of the asset, that figure substantially drops. Now back to balance sheet, okay? Pretty soon, but I'll just finish off on just this depreciation concept. So in the balance sheet, you list purchase price, accumulated depreciation, and new written down value, which we mentioned. Now, total assets is the addition of current assets plus non-current assets. Then in the balance sheet, you list your liabilities, your loans, both short-term and long-term, starting with current liabilities, which are short-term loans. The word payable is indicative of a current liability. Examples: salary payable, accounts payable, and bank overdrafts. You find the figure for total current liabilities. Next, you list your non-current liabilities, your long-term loans, such as mortgages, bank loans, leases. You find the figure for total non-current liabilities as well. Now you find the figure for total liabilities by adding up both total current liabilities and total non-current liabilities, okay? So total liabilities is the addition of total current liabilities and total non-current liabilities. Just some tips: don't forget to add up. Don't forget to add up any figures in each category. Don't forget any subtotals. Check additions in each category back to zero with your calculator. Double check your figures by adding up and subtracting, and then doing the opposite to reconcile your figures, because sometimes you will make addition and subtraction errors. Everyone will. Don't forget to put a subtitle of the balance sheet and a subtitle for each categories. For example, current assets. Now, the difference between total assets minus total liabilities, again, is owner's equity. That's the important reason of why we use balance sheet to calculate that figure of owner's equity, net assets. It's found by the deduction of total liabilities from total assets. So I sound like a broken record. And there's the formula just there for owner's equity, which is a very common multiple choice question in uni and college exams. Net assets are the intrinsic value of the business and a ballpark figure for the price of buying that business. But a purchaser may be prepared to spend more for the business, so goodwill is introduced, which is a non-current asset and must be amortized. So when you reduce an intangible asset, the term is called amortization. It isn't depreciation. That's a tangible asset. On the other hand, the buyer may make an offer to buy a business that's well below the net asset figure because perhaps the economy is in a slump, or there's a microeconomic reason that the business is offering a good or service which will eventually be replaced by a new good or service offered by their competitors. So again, owner's equity denotes capital and it's a credit item on the balance sheet, and that brings in the concept of ownership of the business and proprietorship if the business is structured as a sole trader. If liabilities outweigh assets, this is a precarious situation for a company trying to attract new shareholders. If it's a company or the buyer of the business, the company is in debt, vulnerable to takeovers or the prospect of facing administration or liquidation in the Corporations Act of 2001. So let's just flag some items on owner's equity. I found this interesting. So retained earnings in owner's equity is your old profits from previous years, and this year's profit might be added to capital. A negative retained earning figure is accumulated deficit. Common stock is when a company with shares has shares which are owned by shareholders, ordinary shareholders, and that's found by adding up all shareholder holdings who are ordinary shareholders. That's common stock. Preference stock is the capital stock, the volume of shares that's owned by preference shareholders, and they get their dividends paid before ordinary and deferred shareholders. Deferred shareholders have to wait for the other two shareholders to get their dividends, but they pay lower prices for the shares initially. So getting back to preference shareholders, their dividends are often higher than the ordinary shareholders and the deferred shareholders. But when you compare ordinary shareholders against deferred shareholders, they're in a bit better position because they're paid their dividends first as well. Treasury stock. Now that's the stock of shares that has been repurchased from the shareholders by the company. And so when that happens, the paid up capital figure for shareholders was reduced, and it increases the value for treasury stock. Okay, so that's an adjustment. Some capital, called additional paid in capital, might not even be shares at all. It's an amount that's on owner's equity that isn't a shareholding. It's just capital, not held by a shareholder as shares. It's capital with the company. When dividends are paid to shareholders, the funds are drawn from retained earnings, which reduces the figure and overall capital. If a dividend is declared but not paid to a later date, then dividend payable is in the current liabilities. Okay, dividend payable in the current liabilities. You debit retained earnings and credit dividends payable. That's the general journal entry. But when dividends are actually paid, you debit dividends payable, reduce the liability, or smash it to zero if there are all dividends payable go to zero, or which all go to the shareholders, and you credit cash. Now, actually, that's not the end of the presentation. I haven't covered the example of the balance sheet. Maybe it just sort of disappeared somewhere. Hang on, just bear with me. I'll find it very soon. Look, I've still got that. If you'll just stay with me, I can find it in another document I've got, and it shouldn't take too long to see. I'll just close that for a tick. It's in this. It's in this these set of notes. I'll find it. Don't worry, and I'll put the font up so everyone can see it. Sorry about this. Where's that balance sheet example? Oh yes, I'm getting closer to it. There it is. And I'll just have to put the font up as well. Right, so I'll just select font 36, go to the top of the balance sheet. So some tips. Think in thousands. And just keep thinking 3 zeros, 36,000, 76,000. Check that the calculator calculates back to zero to reconcile your figures. So the name of this balance sheet is Joint Micro Reform Corp balance sheet. And I should put in as at 30th of June 2021, say, and that is the balance day in Australia, the end of the financial year. And if it's the balance sheet is used for official reporting, it's a statement of financial position. at the end of the financial year, along with the other financial statements, the profit and loss statement and the cash flow statement. So we first list the assets. So I could have put assets. First list the assets. We start with current assets, bank $20,000, inventory $50,000, accounts receivable, also called debtors, $25,000. So the total current asset figure is $95,000. Then we list the non-current assets. And you've got to find the total non-current asset figure. So land is $90,000, plant and machinery $80,000, motor vehicles $25,000, goodwill $5,000. I didn't have buildings and building, maybe they're just renting. So, but they do have some land. Maybe they've got a parcel of land somewhere for investment that they're going to be selling soon. But they're the total assets. Add them all up, $200,000. If it's a statement of financial position, don't forget to list assets such as motor vehicles with the format of original purchase price less accumulated depreciation, gives written down value for that point in time. So an example would be the car was originally $40,000 with accumulated depreciation underneath in brackets of $15,000. That's adding up all the depreciation expenses. That's a negative figure, $15,000. It's in brackets. So the difference between $40,000 minus $15,000 gives you a written down value at that point in time of $25,000. And that point of time is, we said, 30th of June 2021. And that format is the format for listing assets in the accounting standards. So we add up both the current assets and the total non-current assets. It gives us that figure, $295,000, and now we list the liabilities. We start with the current liabilities, salary payable, accounts payable, bank overdraft. Then you get a figure for total current liabilities, which is that. Next, you list non-current liabilities, your long-term loans such as bank loan, mortgage, leases. You find a figure for total non-current liabilities, $225,000. Then you add up both your total current liabilities plus your non-current liabilities to get that figure, okay? And finally, to get owner's equity, you find the difference between total assets minus total liabilities. So that's the figure for total assets, $295,000. You deduct total liabilities figure from that figure to get owner's equity, okay? So now we can wind up. I'm really sorry about that. I don't know why I didn't put that balance sheet, but we managed to find it. So that's the end of the presentation. I'm Stephen from TEFAT, and I hope you found this presentation useful, and I'll be doing one on the cash flow statement and depreciation fairly soon. Bye.